Welcome guys to today's video. So in today's video we are going to discuss about the reversal candlestick pattern. So we'll discuss about the bullish reversal candlestick pattern and bearish reversal candlestick pattern. So basically the candlestick is a way of displaying the information about an asset in a price movement, and candlestick is a chart or one of the most popular component of a technical analysis, enabling the traders to interpret the price information quickly and with just a few price of a bar. So we'll discuss brief about the each and every pattern. So first of all we'll move toward the bullish candlestick pattern, and then we switch toward the bearish candlestick pattern. We'll discuss about them in briefly. So we'll move toward the first bullish candlestick pattern, which is hammer. As you see in the image, it's one of my favorite candlestick pattern, as you all of you guys are aware about it. So basically the hammer candlestick pattern is form of a short body with a longer lower wick and is found at the bottom of downward trend. So basically a hammer shows that although there was a selling pressure during the day, ultimately a strong buying pressure drove the price back up, and the color of the body can vary, but green hammers indicate strong bull market than the red hammer. So basically there is a two types, the green hammer and the red hammer. So red hammer indicate the bearish market. So but if you compare the both the red hammer and a green hammer, the green hammer is a more impactful according to me, as I backtested it for 1.5 years now almost. So it's one of my favorite pattern. Like every trader loves this kind of a candle. If you see this kind of a candle, you can go long. So this is the one of the best candlestick pattern according to me. So we'll move toward the next pattern. So let's see, the next pattern is bullish engulfing. So all of you are guys aware about this pattern. This is the most common pattern which is used by everyone. So in bullish engulfing pattern is form of two candlestick. The first candle is short red body that is completely engulfed by the larger green candle. You can see in the image, the first candle is a short red candle which is the completely engulfed by the second candle, which is green candle. Though the second candle day opens lower than the first, the bullish market pushes the price up and culminating the obvious win for buyers. So what happened here, you can see on the second candle opens with a slightly lower than a first candle, but it's closed on the upper side of the first candle. So you can see there is strong buyers are under controlling the market. Buyers have taken the market completely, so you can go long on such position. So this is one of the most useful pattern, most commonly used pattern. And we'll move to the next pattern, which is three white soldier pattern. So I don't know how many guys know about this pattern, but this is it's also kind of a pattern which is used by a lot of traders. So you can use it also daily time frame also, and in intraday also you can use it. So what happened, the three white soldier pattern occurs over the 3 days. You can see the three candle, it is daily time frame. It consists of the consecutive long green candles with a small wicks. You can see in the image the wicks are so smaller, even the third candle doesn't contain any wicks, which open and close progressively higher than the previous day. You can see there is it's like a steps, you know, they are opening higher than the previous candle, and it is a very strong bullish signal that occurs after a downtrend. You can see the downtrend from one side, and after that this three white soldier pattern has become and shows a steady advance of buying pressure. You can see how buying pressure has been developed, so you can go long on such position. This is the one of the best pattern, as you say. You can analyze all these patterns in daily time frame also, or in intraday time frame also. These patterns are more likely to work, not 100%, but you can like backtested it, and then you can find is this useful for you or not. So we'll move to the bearish pattern now. So the first bearish pattern, it's completely opposite about the bullish pattern, as we see earlier. So on a bullish pattern we see the hammer, so it's completely opposite of the hammer. It's like a this pattern name is a shooting star. It's completely like the star is fallen from the sky. The shooting star is the same shape as the inverted hammer, but is formed in an uptrend. So it has a smaller lower body and having the longer upper wick. So upper wick represent there is a strong selling pressure on this upper level. So this is clear indication to go short. You can see after that the rally. Usually the market will gap slightly higher on opening and rally to an intraday high before the closing at a price just about to the open, like a star falling to the ground. As you see, the market opened slightly higher, but the sellers are not allow market to the go upside, then market they push the market at downside. So it's completely looking like the star falling on the ground. And as you see the as I mentioned earlier in a lot of videos also, like if you found the wicks on upside or downside, if the wicks is on downside, go long. If a wicks is on upside, go short. So this is the basic, and this is the one of the favorite pattern, which is completely opposite of the first pattern as you see in the bullish trend, which is hammer pattern. So this is also one of the useful pattern. A lot of traders are used to got to know about this now. Then they please examine this in your trading platform, and it will give you the benefit. So we'll move to the next pattern, which is bearish engulfing. It is similar to the bullish engulfing, the same pattern, but it is only in a downside trend. So in a bearish engulfing pattern occurs at the end of an uptrend. You can see there is uptrend, and at the end of the uptrend you can see this bearish engulfing pattern. The first candle has a small green body as we see in a bullish pattern, this same pattern, but here the first candle is a green, and which is engulfed by the subsequent long red candle. The opening is slightly higher than a first candle, and the closing is the downside of the first candle. So it signifies a peak or a slowdown of a price movement and signs of an impending market downturn. The lower the second candle goes, the more the significant trend is likely to be, and is in bearish engulfing pattern, the more the second candle is on a downside, the more the market has chances to go at the downside. The lower the second candle goes down, the more the significant the trend is likely to be. Like if you see the upside trend is going on, and suddenly this pattern has come, and suddenly the second candle, as much as big the second candle is, the much the trend is go at the downside. And if you don't want to take risk at the first candle, then go short on a second candle also. You can take short position on the second candle also. We'll move to the third pattern. And the third pattern is similar to we had seen the third pattern in the bullish candle also. It is a similar opposite of this trend, which is three black crowds. So we'll discuss about the trade. Like if you see the trending market, and there is a continuously three red candle which is closing on the downside of each candle. So the three black crowds candlestick pattern comprises of the three consecutive long red candle, as you see in the image, with a short or a non-existent wicks. The wicks is not exist, or a very short wicks. Each session opens with a similar price to the previous day, but the selling pressure pushed the price lower and lower with each close. You see the closing of the candle is getting lower and lower. The traders interpret this pattern as the start of a bearish downtrend. This is a novice trader can understand this, as the sellers have overtaken the buyers during these successive trading days. This is completely, if you again the same thing here, if you don't want to take a risk, then again go short on the second or third. It's not the third candle which too much, but you can go short for the second candle. So this is the 6 candlestick pattern. According to me, I choose the candlestick pattern which is more likely to used by the traders, and which is more easily. There is a lot of candlestick pattern is there, but it's very complicated to find this pattern on every day on a chart. So rather than these are the some candlestick pattern which every day, not every day, but twice, once in a 2 day, this pattern has been come. So you can trade according to that. First of all, back test it, and then you can examine this trade. Out of this 6 trade, the shooting star and the hammer, this is the one of the most common pattern, and you can find this pattern every day, almost every day. So you can use it. And this is it for today's video. We'll discuss more about the chart patterns and all the stuff in the next video, and you can practice these candlestick patterns on paper trading, on Neo Stock also, on TradingView also. So we'll discuss more about the next video. Till that, peace out.